Hey everybody, thanks for joining Harry and I again for one of our videos. It's the middle of May 2022 and we figured that with everything that's been happening in markets this year, we would just do a mid-month market update. So Harry, why don't you talk about the volatility that's been persisting this year and sort of explain for everyone how we've gotten to where we are now.
Sure, David. That's a great topic. I guess when you're trying to understand things, we might as well go back to the start. And the start of this was COVID. COVID came in, governments and markets went crazy. So the governments panicked. They didn't know what to expect, and to be honest, none of us did. And so the government quickly lowered and lowered interest rates, and they quickly flooded the market with a ton of extra capital, billions and billions, trillions down in the US. And they wanted this because they were worried that everything was shut down and things were just going to collapse. So they threw all this stimulus out. Now, what happened was we saw this immediately V-shape. After the drop with COVID for 3 months, we saw this immediate V-shape and it just rocketed back up. And, we had these great years of performance. But the government was still concerned because COVID was persisting. And even though market conditions were good, COVID was still persisting there, and they were worried about supply line issues and all of that. So they kept interest rates low. They kept flooding more and more capital. And now we're actually starting to see the negative side of all of that. The biggest concern right now out there with governments and the market is inflation. And we've got this inflation because the government has left all this stimulus probably a little too long, but they decided let's err on the side of caution. So now we're starting to see that unwind and interest rates are starting to move up. But what the government didn't prepare for is two other things. One, that China, anytime they have one case of COVID, is just shutting down their whole economy all over again. And this is again affecting supply lines and increasing inflation because it's harder to get goods. They also didn't plan for the Ukraine and Russian war. So again, all of the energy, gas and oil and food and all these other things are now interrupted from these two countries, again causing more and more inflation. And what we're seeing is this absolute fear that, oh my God, with these inflation rates going up, the governments are going to have to jack interest rates up and we're going to get 20% interest rates again, and suddenly all the real estate market's going to collapse and all the businesses are going to be unprofitable. And this is sort of the fear that's spinning around and why we're seeing the markets, react the way they are. And again, we've seen these type of cycles before. The triggers in these cycles are different, but we've seen these cycles many times before, David. And in a bit, I'm going to ask you to maybe show a few slides and talk about what's happened in the past to just to reassure everything that this isn't new. The triggers are different, but you'll be just fine. You just have to be a little patient going through this process.
Yeah. And another thing for people to remember, like I was just at an investment conference downtown yesterday, Harry, listening to some portfolio managers from Fidelity talk. And a lot of them obviously share some concerns about the markets and whatnot from a macroeconomic standpoint with inflation, the war, and also China's zero tolerance toward COVID. Those are all issues, but a lot of them are also excited by the fact that the baby in a lot of senses have been thrown out with the bathwater. There's a lot of great companies that have been really sold off that have great earnings and will probably continue to have very good earnings next year, 2 years from now, 3 years from now. And so these portfolio managers are able to load up on some of these stocks that have really sold off probably too far during this correction. They may continue to drop a little bit in the next 6 to 12 months. That's the thing with the markets that none of us can predict in the short term. But for investors who can stay committed, stay patient, and stay invested, 2, 3, 4 years from now sounds like a long time when we're going through these corrections or bear markets. But 2 years from now, you'll look back and say, gosh, I'm glad I stayed invested and trusted the portfolio managers to make those decisions for me in finding value in this market. But yeah, to your point, Harry, there's definitely some excellent slides that we'll put up on the screen now and just sort of review. This first chart shows some of the top reasons not to invest over the last 3 decades. As you can see, there were numerous crises, wars, recessions, pandemics, and market crashes, which caused tremendous bouts of volatility throughout the many market cycles during the last 30 years. Now, with this second chart, despite all the reasons not to be invested at certain periods of time during the past 30 years, investors who did remain invested throughout both bear and bull markets were rewarded. We recognize that every one of our clients invests to grow their money and no one wants to see their portfolio drop in value, but the stock market has experienced many ups and downs over the years, but the general trend over time is up. If you stay invested during volatile periods, history has shown you will get good results. Over the past 30 years, Canadian stocks have averaged 8.48% annual returns, and a more conservative balanced portfolio of 60% Canadian stocks and 40% bonds achieved an average annual return of 8.14%. By comparison, investing in 5-year term deposits achieved an average annual return of only 4.28%. So this chart just shows that if you can stay invested through good and bad times in a balanced portfolio, you will do better than lower risk guaranteed investments. The third chart and the last chart we'd like to show you today is that market corrections are not uncommon. Markets can have negative returns, and in fact, negative returns are common. Over the past 35 years, there's been a point in every single year where returns were negative, even in years where the market ended up having great performance by year's end. In 2009, the TSX was up 30.7% by year's end. However, earlier in the year, it had dropped by 20% at one point. So far in 2022, Canadian stocks, as measured by the TSX, are down 4% year to date, and US stocks, as measured by the S&P 500, are down 14% year to date. These drawdowns are definitely no fun to be invested through, but staying invested in order to participate in the positive returns when markets inevitably recover has been the correct thing to do through each market cycle historically.
Those are awesome points, David. As always, if you have any questions, please don't hesitate to give Dave and myself a call. Take care.